What can we learn from a company's financial statements? Are these statements likely to inform us, or can they be used to try and mislead us, or a bit of both? This week, we are considering the second item in our toolkit, accounting analysis. We are interested in the extent to which the financial statements do a good or a bad job of reflecting the underlying economics of the business. Last week, we considered business strategy analysis. How does the business make money? This week, we need to think about how well the business strategy and its effectiveness or otherwise are reflected in the financial statements. Accounting quality means different things to different financial statement users. As an investor, it might mean accounting that helps with investment decisions. As a lender, it might be accounting that takes a conservative approach to revenue and asset measurement, as that will best protect from losses. Earnings quality is a subset of accounting quality. Broadly speaking, it considers the extent to which earnings, net income, or some other measure on the income statement, like operating profit before tax, reflects the underlying economic performance of the business. Have a look at the earnings quality document on Teams. You'll see a whole bunch of ways that CFOs define earnings quality. Some of these are related, but the important point is that there is no one standard definition of quality. A number of factors explain variation in accounting quality. First up, let's consider the accounting rules. You should know from your introductory accounting classes that listed companies are required to use accrual accounting, as opposed to cash accounting. Accrual accounting allows firms to recognize revenues and expenses when they are earned or incurred respectively, and that this does not need to match the inflow and outflow of cash. It also allows firms to record assets and liabilities on the basis of expected future receipts or payments of cash or other economic benefits. In other words, accrual accounting modifies cash flows to come up with a different measure of performance than net cash flows. We often hear in finance that you can't trust accounting numbers because the accrual process allows managers to use their discretion, and that you should therefore only look at cash flows. It might be useful then to examine whether this modified performance measure does a better job of capturing underlying economic performance than net cash flows. The accrual process requires managers to make estimates about the future. When will they collect accounts receivable? How long they will use their equipment for? And how much long service leave they will need to pay? Is it good or bad that these estimates are made? Well, the people running the firm, that is, the managers, are hopefully in the best position to know these things. So managers' accrual estimations or decisions therefore have the potential to be informative to us. On the other hand, if managers know more than we do as outsiders, then they could use their discretion to try and mislead users of the financial statements. Now, why would they try to mislead? Or more formally, what incentives might managers face to deliberately mislead users of financial statements? We can classify many of these incentives into two broad categories: market-based incentives and contractual incentives. I'll discuss each of these in detail in some accompanying videos. In some cases, it is the accounting rules that make it difficult for managers to show the underlying business performance. Take, for example, a rule requiring all research and development activity to be expensed in the period in which it occurs. This is the case in the United States. So, regardless of whether or not the R&D expenditure gives rise to future revenues, it gets recorded as an expense. The alternative is allowing firms to defer some of the expenditure, that is, to create an asset, as is the case for development expenditure under the IFRS rules. The potential problem for an expensing all R&D rule is that it does not allow firms doing good R&D to distinguish themselves from firms doing bad R&D. Note though that firms have other ways that they can communicate with their shareholders. We'll cover those in detail in our next unit. As an analyst, your role in assessing accounting quality follows the following steps. First, you need to identify key accounting policies. You need to focus on the 2 or 3 policies that are most critical for your firm and its business operations. This will vary, particularly by industry. For example, key success factors in the banking industry include interest and credit risk management. However, in the retail industry, inventory management is a key success factor. For the key accounting policies, you then examine the extent to which your firm has any accounting discretion or flexibility. To do this, you need to know the relevant accounting rules for the key policies. For example, how should your firm treat their research and development expenditure? You can easily find the accounting rules online. You can then evaluate the accounting strategy, or the way in which managers choose to exercise their discretion in accounting. Does your firm adopt similar accounting choices to other firms in the industry? Do you see any evidence that your firm is systematically trying to bias its reported performance in a particular manner? As part of your accounting analysis, you should examine the extent to which your company explains its accounting policies and choices, and especially those choices that depart from industry norms. These disclosures can be found in the notes to the financial statements, as well as in other investor communications. Finally, you would assess the extent to which your firm has any red flags or indicators of questionable accounting. We've provided you with a list of things that CFOs consider to be red flags when assessing earnings quality. Chief among them is earnings that do not correlate with cash flows. So examine carefully situations where earnings are going up, but operating cash flows are declining. Also pay attention to accounting choices or earnings patterns that deviate from the company's peer group or industry. If you think that your firm is not reflecting the underlying economics in their financial statements, then, as an analyst, you can try and undo any distortions. For example, you can reduce the value of overstated assets or increase the value of understated liabilities. You can adjust for accounting rules that require firms to expense all research and development. Finally, your accounting analysis could involve the recasting of the financial statements. This is a way of standardizing the financial statements so that they can be compared easily over time and with peer companies. It's the sort of thing you'll see done in the FactSet data, for example. So, in summary, accounting analysis considers the extent to which the financial statements do a good or a bad job of reflecting the underlying economics of the business. You consider the role of accounting rules and the discretion that these rules give firms and their managers. You'll also consider the incentives that your firms face in reporting performance. Look for red flags in the way in which your company does its accounting and assess the accompanying disclosures. Finally, you can adjust the reporting numbers to better reflect what you believe an appropriate accounting would be. All of this then leads into our next analytical step, financial analysis. By having a strong understanding of the firm and the way in which it reports, you'll be better placed to assess recent financial performance and to then subsequently forecast future performance. Now, have a think about the accounting for your major project firm and whether it does a good or a bad job of reflecting the underlying economics.